I think that we've been taught in the last 40 years, which were very benign, to believe that the Fed had our backs, to believe that government had our best interests at hand, to believe that you buy the dips. The fact that they closed the ETF is really good news. It means that coal is deeply out of favor. Many people don't know that the third best performing commodity asset class in 2021 was coal, allegedly a dead asset class.
I was able to interview Rick Rule on a panel recently, and if you don't know Rick, he's an amazing guy, just really well knowledgeable in the metal space as well as other minerals. He's been doing it for over 40 years, and on this panel, he gave some really amazing advice as far as what we should look at in 2022 when it comes to our investments, when it comes to inflation, when it comes to the timing of how all this is going to go down. So my name is Bronson Hill. I'm the CEO of Bronson Equity. We do multifamily investing as well as real asset investing, and we do educational events. And so this is from an educational event. But stick around here until the end because Rick gives some amazing advice on what you should be looking at going into the new year, into 2022, as far as what things should look like. So in this section, Rick gets into a history lesson and just talking through his opinion on what's happening right now in the market.
With regards to recession, I have to say, between Doug Casey and myself, we have completely accurately predicted 17 of the last 3 recessions. So I'm just going to disqualify myself on that.
Peter Schiff as well, right? Peter Schiff has done that
too. He's a Peter come lately to that. The other comments, though, I think are worthwhile, and particularly the idea of the delayed impact of inflation statistics on people's psyches. Unlike the rest of you, I was here for that 1970s event, and mostly cognizant. I was very young at the beginning, but I'm reminded that in the period 1967 to 1972, 1973, the real inflation numbers were high. Interest rates, then price controlled on savings products, were low. In other words, the circumstance that Americans faced at that point in time was eerily similar to the circumstances that they face today. And the response of the savings and investment public was similarly somnolescent. We had been conditioned through epically good conditions through the 50s and the 60s, good economic conditions, to expect that things would only get better in the United States. And the consequence of that was, despite the fact that simultaneously we fought the war in Vietnam and the war on poverty, lost both, of course, and had a fiscal hangover around both of those, expectations and actions of investors and consumers didn't change in the face of facts for a very long time. When people ask me now, Rick, how come people aren't acting in traditional ways around inflation, even in the face of both negative real interest rates and inflation? I think that we've been taught in the last 40 years, which were very benign, to believe that the Fed had our backs, to believe that government had our best interests at hand, to believe that you buy the dips. This is not a natural set of circumstances, but the incongruity of it is lost on people because the last 40 years that they've been through is so benign. My suspicion is that 40 years is over and a different 40 years is starting. I'm not one of those who says it's going to be all doom and gloom. I certainly at least hope for me that I'll stick handle my way through it. But I think the circumstances, the fact that the circumstances are demonstrably changing means that investors' responses and savers' responses must change too.
So here Rick states he's been investing for 40 years, and it's been a pretty good 40 years, right? We've had a bull bond market. Borrowing has gotten cheaper and cheaper. Right now, at the time of this video, the 10-year treasury is at 1.5 or 1.6%. That is very unusual, right? And so he says many people alive today don't remember what it was like to invest in the 70s when inflation was really high, sometimes almost as high as 20%. And so he gives this term, he calls it return-free risk, right? So you borrow, to put money into a 10-year treasury when it's 1.5 or 1.6%, and inflation is 6.5, 7.5 or higher percentage, right? It doesn't make sense. You're actually getting less money, and it just seems like a very poor deal. So he gets into that a little bit more here in this next section. He gets into kind of what he sees happening in the near future.
It doesn't matter much because I can't. I would caution all of us to understand that in the near term, confidence, which is what holds things together, is weight in narrative, not an arithmetic. And if you pay attention to the arithmetic, you tend to underestimate the length of time that it takes for people's behavior to change. Recency bias is a very, very reasonable, very, very powerful thing. People's expectation of the past is set by of the future, is set by their experience in the immediate past. If you look, as an example, around the arithmetic concerning the U.S. 10-year Treasury, that is to say, you lend money to the U.S. government irrespective of what you think of their credit quality, and they pay you 1.7% in a currency that they acknowledge is depreciating in terms of purchasing power by 6.5% compounded. Simple arithmetic, 1.7 minus 6.5. Not a real good deal. My friend Jim Grant calls it return-free risk. And yet billions and billions and billions of dollars are committed to return-free risk. A situation that's illogical like that can go on until it doesn't. And when people ask me what I think is going to happen in 2022, I sort of say, why do you care? What you need to concern yourself is what's going to happen over reasonable periods of time. And I've, further to that, sorry for all these old man's homilies.
We like it.
But, one of the things that I like to do is concentrate on actions and things like that, where the answer necessarily begins with when, not if. When people ask me to peer into the minds of the big thinkers, despite the fact that that's tempting, preferably with a pickaxe or a shovel or something like that. But I know I can't do it. And so if they ask me, will things change? Will confidence change? Will confidence break in 2022 or 2023? I have to say, I don't know. But I can say with a very high degree of confidence that there will come a time when people are no longer willing to receive 1.7% interest rate in a currency that's losing 6.5% a year. I mean, I get that. The answer to the question then is a when question, not an if question. And I'm very comfortable with when questions. Let's say that I got out of the way of that equation 2 years too early. And let's say that I deprived myself of 1.7% in the U.S. 10-year Treasury, even in favor of 25 basis points in cash. But I saved myself the readjustment in bond principal when the interest rate changes that chopped 30 or 35% off my bond price. I'm actually pretty happy with that trade. So my own circumstance is that you can't tell what's going to happen in a year. You can't tell what's going to happen in 2 years. However fascinating that topic might be to you, what you're doing is trying to know the unknowable. What you need to do is pay attention to the inevitable. It may not be imminent. And you need to prepare yourself as best you can for an uncertain world where the outcomes are probably less benign than they have been for the last 40 years.
And so Rick really schooled me here, right? The idea of not trying to time the market, but yet focusing on the inevitable, that it is coming, we don't know the timing, and it's important to prepare yourself. And he also gets into the fact that bull metal markets can last a long time. He thinks that we're due for one in 2022, that it may just continue. And so he gets into that in this next section.
Sure. I mean, traditionally, the precious metals markets have done very well during periods of time when people are concerned about the maintenance of purchasing power in traditional fiat-denominated investments. As we mentioned earlier, in the decade of the 1970s, the biggest bull market in precious metals of my career, there was a 5-year delay from the time when the need for change was apparent and the change that, the change in people's attitudes. If past is prologue, and I suspect it is, we're going to have a very, very, very good precious metals bull market. Will it happen in 2022? I have no earthly idea. What I can tell you is that precious metals bull markets are of much longer duration than most people think. People have said to me, Rick, this bull market in precious metals, it's stalled now, but it's been underway for 3 years. Did I miss the boat? I don't know. The first one of my career was 11 years. The second one of my career from 2000 to 2011 was also 11 years. So I suspect that 3 years is short of tooth and that this one has 5, 6, 7 years to go. Dimension too. People say, well, Rick, the gold price has already gone from 1,000 to 1,800. Have I missed the boat? Well, let's go back to history again. First one, $35 an ounce to 850. Admittedly, the 35 was price controlled. But the second one might have been more illustrative, $253 an ounce to $1,900 an ounce. If you have a circumstance where people's faith in debt instruments is challenged, consider the fact that institutional investors worldwide have been in a mantra where 60% of their assets are in equities and 40% are in debt. If you're a long-term investor, pension fund, insurance company, university endowment, and you come to the not so stunning realization that 40% of your portfolio is costing you money every year, your ability to provide for pensioners 20 years from now, your ability to make whole life insurance policies 20 years from now, your ability to run Stanford University 20 years from now is being called into question because 40% of your portfolio is yielding you a guaranteed loss. You need to be able to reallocate some of that portfolio. If you come to be afraid of inflation, which I suspect you would be if you're getting 4.7% yields on junk bonds and your purchasing power is declining by 6.5%, and you look for alternatives, one alternative that you might look to is an asset class that has historically done a good job during periods of inflation. And this is where the arithmetic gets really interesting. It is estimated today that 0.5% of savings and investment assets in the United States is denominated in precious metals or precious metals related assets. JP Morgan Chase suggests that the same number in 1981 was in excess of 6%. But what they've documented is that the 3-decade mean was 1.5%. So if negative real interest rates were to cause the largest institutional investors in the world to be concerned about the fact that 40% of their portfolio was guaranteed to lose the money.
So Rick mentions all the upsides of buying metal. He said that bull markets for metals can last for years. He mentioned 2000 to 2011, there was a gold metals market and it lasted obviously for 11 years. We could be in the middle of a bull metal market. It could be another 5 to 7 years where we see gold going up. So he said also one other thing is that if people start allocating more of their wealth to metals, he said only 0.5% currently in the US savings is dedicated to metals, which is really, really low. So that's something to consider. He also, in this next section, will get into why he thinks coal is such a great investment. So stay tuned, take a look at this. Really interesting.
The fact that they closed the ETF is really good news. It means that coal is deeply out of favor. Many people don't know that the third best performing commodity asset class in 2021 was coal, allegedly a dead asset class. Many people don't know either that the highest demand year that coal has ever enjoyed was 2021, a dead asset class. You need to do some research because the most important producers of coal are in a situation where coal isn't very important to them, which is to say very large multi-commodity mining companies are the largest and lowest cost coal producers. It's tough to find a pure play in coal. There are some, Peabody, Arch, Colonial, there's a range of them. You need to understand that if you buy them, you're buying the second tier companies. You're buying second tier companies at probably a 50% discount to the net asset value of their future cash flows at today's commodity prices, which is to say they're stupidly cheap. And they're also fairly well-mannered in the sense that they're generating tremendous free cash flows, and they're giving that free cash flow back to their owners, which I think is a very good thing. One example of just how cheap these things are and how good George's instincts are, Glencore, a major multinational company, mining company, bought one of their partners out of a very large coal mine, probably 30 years reserves, and they paid 1.5 times free cash flow for half the mine. In other words, they're getting what, a 45% earnings yield on the purchase. Wow. They're getting a 45-year earnings yield on a mine that's making about $1 million a day. It's not an insignificant asset. Wow. That'll tell you just how out of favor coal is. But you'll need to do your own research there.
So coal is very deeply out of favor. A lot of this ESG and green energy folks, they don't want coal to exist. But the truth is the world needs it, right? So this is an unloved, out of favor asset that should be something to consider for 2022. So I love that he gives us a specific recommendation, not for a specific investment, but just to take a look at this and evaluate it for yourself and see what you think about it. So, when it comes to, in terms of advice for going forward, one of the things that I look at is how you're educating yourself, because that's the best investment that you can make. So Rick gives some specific tips on books and things you can do to prepare yourself going forward.
Well, I in fact developed an edge in my 20s, and mercifully I've stayed in the same business all that time, which is probably how I've come out okay. In terms of more general discussion, I mean, the first thing I do is have people re-listen to what George just said about an edge. But in terms of general investing knowledge, I love books. I would start with Economics in One Lesson, the old classic, to learn about how the economy actually works, as opposed to the way that you're taught that it works. It's a simple book. It doesn't take much skill to read it, and you learn a lot from it. The foundational investment book, from my viewpoint, is The Intelligent Investor by Ben Graham. Almost 100 years old. It's older than me. Nothing really has changed since he wrote that book. It's the best investment book ever written relative to the effort required to read it, which is low. If you read it, don't just buy it, read it. If you read it, the best investment book ever written, irrespective of qualification, is Securities Analysis, also by Ben Graham. If you read that book, invest for the long term, and employ the discipline in that book, you will, not can, you will get rich. It's just that it's very difficult to invest in the time frames that they talk about and not be carried away by fads. The most impactful book in my life and in my career, the best book I've ever read, and people will hate me for this if they start it, is Human Action by von Mises, because the economy is really the actions of a whole bunch of individuals coming in contact and talking about the motivation behind individuals, and hence the motivations behind groups, is something that allows you to understand every aspect of society, including economics and including investment. So one more time, Economics in One Lesson, The Intelligent Investor, Securities Analysis, and then the ultimate sleeping pill, Human Action.
So I'm a big book reader, and obviously Rick is as well, but he recommends a few books. He recommends the book Economics in One Lesson. He recommends some of Ben Graham's books, particularly Securities Analysis. And then he also talks about von Mises' book, Human Action. So I recommend you take a look at all of these books. But anyway, I hope you found value in this video. We really exist here at Bronson Equity to educate people to make better investment decisions. Our business is working with investors to reduce taxes and have consistent returns through multifamily investing. So if you're interested in connecting with us, check out the link below. But I want to know in the comments below, what was the biggest takeaway that you got out of this video from Rick? Go ahead and stick that down below. Consider subscribing. We look forward to seeing you on the next video.